Most people think you need about $3 million a year to generate $100,000 in retirement income. Today, I'm going to walk you through a framework that generates that kind of passive income with just $1 million. And we're going to do that by walking through 5 different investments in order to get some diversification in that portfolio. So no landlord headaches, nobody calling you in the middle of the night, and you don't have to worry about the volatility of the stock market because this is a debt-focused strategy with a lot less volatility. And so we'll walk through this exact hypothetical portfolio, and we'll show you some steps you can take to dramatically reduce the risk of that portfolio. Okay, so the goal of this portion of your portfolio is income. Normally, this would be the 40% of your portfolio if you had a very vanilla 60-40 portfolio, which would be 60% stocks and 40% bonds. But 40% bonds, you're only generating maybe 4 to 5%, more like 4% today with short-term debt. That's not generating a lot of income. That's barely outpacing inflation. So what we like to typically recommend to our clients and investors is adding some alternative assets, adding some private investments that are debt-focused that have higher yields. Now, they're not as safe as bonds, but they have a lot of protection in that. They come way below the equity in the capital stack. There's the debt component, and then there's equity on top. That equity is the margin of safety for a debt investment. So the goal here is 8 to 10% in yield and distributions that might be coming monthly, that might be coming quarterly. A lot of them come monthly, which is great. It almost replicates a paycheck. And so on $1 million, that range could be $80,000 to $100,000 in passive income. And of course, we don't want to put the full million into one investment because strange things happen. So we want to spread it out and diversify. So that's just the overall goal of what we're trying to accomplish here. Let's break down exactly what that's going to look like. All right, the first option is going to be private credit. So that's just loans made to businesses. Pretty simple. The business needs to grow. They need to buy new equipment. They want to expand into a marketplace. They're going to go out and they're going to buy that equipment with the loan that you give them. So you, the investor, are making a loan to the company. They are paying you interest payments in return for that loan, just like you would with your home lender. And the nice thing about this is that from the borrower standpoint, you don't have to go to a big giant bank on Wall Street. You don't have to go to your regional bank and sign a bunch of complicated paperwork. It takes 60 days to close the loan. Oftentimes when you're dealing with private credit, it happens much faster. You can get the loan quicker. Therefore, the yield's a little bit higher. So it says the investors get a higher return for giving that flexibility to the borrower. All right, real estate debt, that's even simpler. We're talking about mortgages on commercial buildings. It could be an industrial building. It might be self-storage, retail, multifamily, that's apartment buildings. So everybody understands real estate. Real estate has a debt component to it. Instead of being the equity owner of the real estate, in this case, we're talking about making a loan to the owner of the real estate. So the real estate investor needs to purchase a property. They want to do it quickly too. They don't want to go to a traditional bank. Maybe they have a unique business model where they need to improve the property and the traditional lender just doesn't understand the business plan. Or perhaps the buyer has an opportunity to purchase an asset quickly. They don't have time to do a 90-day process with a traditional lender. And one of the reasons why these debt opportunities exist today is because banks have really pulled back. After the financial crisis, they were given a lot of regulations from the government, and the government said, hey, you have to keep larger capital counts at your balance sheet. You can't make as many loans. So that created a giant gap in the marketplace. And private lenders are stepping in to fix this problem. They're adding liquidity to the marketplace. That's why it's such a unique investment opportunity, is because there's a lot of product out there that needs financing. There's a lot of investments to be made. And so the demand for debt is a lot higher than the supply of lenders right now, especially in the real estate space, because real estate has had quite the correction. In 2022, it was down substantially because interest rates were spiking. Yeah, the nice thing is that just like you're making a mortgage payment on your house, the borrower is making a payment every month to you. So that's one of my favorite things about real estate debt, is that it typically is a monthly distribution that you're getting. Now, you could go with a fancier private equity firm that is doing a fund where they are paying quarterly, so you can get slightly higher returns, but the majority of investors that are going to allocate to the space are going to invest in real estate debt are doing so when they're getting paid monthly, distributions monthly. And if you're a former real estate investor, right, you're a former landlord, this is pretty compelling because you're used to managing the property, dealing with tenants, dealing with issues. The roof has a problem, the plumbing leaks, tenants calling you at all hours of the night. So you go from an active landlord, right? If you could sell your portfolio and invest the proceeds into real estate debt, all of a sudden you're the bank. You're starting to get those monthly payments that you were used to sending off to the lender when you were an active owner. Now you are the bank. You are getting these great interest payments each and every month. And heaven forbid, one of those months the payment doesn't come, you have this security in the property. You have a loan with a lot of equity on top of you as your cushion that you can go back at, just like a bank would with your house if they wanted to foreclose it if you stop paying them. You can do the same with commercial real estate debt. You can go to the borrower, say, hey, borrower, hey, you stop making your payments, we're going to have to take the keys to your property, and then we're going to go sell it and recoup our principal loan balance. So it's just a much safer way to invest versus equity. There's risk in any investment, of course, even debt investments, but just think about the relative risk, the far less risk that you're taking with something that is debt-like than equity. Okay, the next one is a private equity investment. Now, this isn't set in stone. You could just throw another debt investment in here. We just like to sprinkle in some options that have higher appreciation opportunities in addition to some of these debts. This one in particular is unique in that it has a fairly high monthly distribution profile. This type of investment is a income-focused private equity investment that has more of a focus on income and still has the appreciation ability to generate returns above the yield. And so we like to sprinkle this in to increase the total return opportunity profile here. But it's a minority position in the portfolio that we've laid out here. It's only a 10% allocation because it has higher risk than the other four, which are debt in nature. So this easily could have been another debt investment. This is just something unique to diversify a little bit the portfolio away from just pure debt. The particular segment of private equity that we're thinking about has a very high income component, and so it's slightly lower risk than your traditional private equity investment where you're not getting any income for 3 to 5 years after you make the investment. You actually start receiving income fairly quickly after your investment, at least historically speaking. Asset-backed finance. This is a fancy way of just saying asset-backed investments, asset-backed debt. There's usually a hard asset or something tangible that is backing your loan. So that might be receivables, that might be the inventory of the company. That could be a pool of consumer loans that the company's made. So we're talking about more collateral, a little bit more security than a traditional private credit loan. And so I really like this space. All the dynamics that we talked about with private credit in that banks really pulling back from lending, same thing applies to this category. The nice thing though is instead of relying on a company to report their financials and how profitable they are for a loan, this you can actually see what you're lending on. You can go to the business and count the inventory and be like, okay, well, we'll give you a 50% loan based on the current inventory that you have. And so this is exciting growth space within debt and has very similar risk-return profile characteristics as some of the debt sectors that we've already laid out. Okay, so we just went over the individual components of what this portfolio might look like. And here is this hypothetical portfolio in aggregate. So it breaks down the specific investment. We've added a second private debt investment. We think that tends to be our favorite space within debt to lend, to make investments in, because we are a big fan of hard assets. We're a big fan of lending on things that are tangible, that we can see. We know real estate pretty well, and so do our investors and so do our clients, because look, everybody lives in real estate. Most of our clients own their own home. So people are just comfortable with that investment. And so therefore we generally like to have a little bit more of it in their portfolio. And so we could have made the math really simple here and just done 200,000, 20% each across the board, but we layered in one private equity income focused investment. And so that's the minority 10% position in this portfolio. And then you have the yield ranges. Once again, nothing is guaranteed here. This is just based on historical performance for these asset classes and the types of yields that they produce. And then you have the corresponding income range that would equate to if you achieve those yields for those investments. And so as you could see, the range of 80,000 to 100K here on $1 million portfolio is a fairly substantial boost versus say the 4% that you could get today in a 10-year treasury. And so by no means are we saying that, hey, if you have $1 million, that's your entire net worth, this is the portfolio that you should invest in. No. Right? You would want to add in some stocks, you want to add in some bonds, perhaps, maybe some other asset classes. But if you have multiple millions, and you decide that you want to focus a big part of your portfolio on an income heavy, on a sleeve of investments that generate a fair amount of income, this would be one way to do it. And we tend to like this strategy as some component of an investor's portfolio, especially if this would encourage good behavior in the stock market, because when the stock market is tanking, debt investments tend to not move in parallel with the stock market. They move a little bit differently. They're less volatile. So you've still been able to collect debt investments. You still are generating a return on your investment, even though the stock market is not doing as well. And you can use that income to go ahead and buy more stocks when they are down. So I think the income area of somebody's portfolio enables them to go on offense when others are panicking or they're retreating and selling stocks when they're down because they're getting uncomfortable. Somebody that has a high percentage of income from their investments tends to do better because they can use that income productively to go buy new assets. All right. Okay, so it's not all sunshine and rainbows. What are the downsides here? These are not liquid. These are not bonds that you could sell immediately that day in the open market and get all of your money back. These are illiquid private investments. Now, they are a little bit more liquid than, say, investing in the equity of real estate. Debt tends to be a little bit easier to trade in the secondary market. Most of the investment firms that we work with that make these loans tend to have some sort of liquidity window where they allow for redemptions. But you have to be really thoughtful about this. You cannot put 100%, once again, of your portfolio into this portfolio if you have liquidity needs. A big portion of your portfolio, a healthy chunk relative to what you need, should be in things that are liquid. That's stocks and bonds. This would be one portion of the private side of your portfolio that is meant to generate higher yields, but the trade-off there is that they are not liquid. So that's something to think about. All right, so a natural question might be, looking at this portfolio, which do you like the most? Which are you most bullish about in 2026? I would have to say real estate debt is very attractive at this point. And the reason for that is we've had a pullback. We've had a healthy pullback in real estate because interest rates spiked. So inflation was high, and so the Fed raised interest rates really quick. And that created a downturn in real estate. And so pricing cratered 20 to 40%, depending on the type of real estate. And if you think about that, now, if you're making a new loan to a property that's already had a correction, that means that you are investing your note at a much safer valuation than somebody that was making that same loan, hypothetically, in 2021 at the peak of the market. Now, most of the people that were making loans at that point in time still are doing just fine. But just about every other asset class, the loan payments are still being made. And the loan is what we call money good. In other words, the lender can take back the property and sell the asset to another buyer and recoup 100% of their loan, which is a great place to be from a risk standpoint. That's your downside, is that you have to go ahead and sell the property, but you still get your full loan back, or at least close to 100% of your full loan investment back. And so compared to private credit, which is just a little tougher to peg because you are investing in 20 different industries, real estate specifically already had this big pullback. And so we're coming in at a very attractive time to make high yields, high return on our invested capital in a safer position in the capital stack. All right, so that was a portfolio of high income debt investments. If you wanted to put it in investments that historically have generated higher income returns with lower risk, that could do it. And so if you want to learn more about these type of income investments, there's resources for you down below. If you like this presentation, you're going to like that. Thanks for watching.